There's a paradox in the investing world, and it's one of the biggest reasons that people fail to generate consistent positive returns from their investments. And in this video, we're going to be discussing that paradox and how you can avoid it. Hey, if you don't know, my name is Evan. This is My Money Marathon. I create content centered around personal finance and beginner investing, helping beginners build their wealth as quickly and efficiently as possible. And in today's video, we're going to be discussing a very common paradox in the investing world that causes a lot of people to generate lower returns than they should. There's a common quote that you may have heard inside or outside of the investing world that is, hurry up and wait. And this sounds like a complete oxymoron of a statement, but we're going to discuss what it means and how you can apply it to your investing strategy. This seemingly conflicting statement is actually a really good summary of the two most common reasons why many beginner investors fail to succeed in the stock market. The first part of this quote, hurry up, demonstrates how time is so important in investments. When it comes to investing, especially in the stock market, compounding is the real vehicle you're relying on to build you massive long-term wealth. And that takes a ton of time. So the earlier you're able to get started investing and give that compounding a chance to grow, the better. As I've discussed before, even starting a single year earlier with investing can make you easily tens of thousands of dollars by the time you retire. The second part of the statement, and wait, refers to the long-term mindset you should have when investing, especially in the stock market. Once you've hurried your way into investing, it's time to be patient. On a time scale of 10, 20, 30, 40 plus years of investing, these short-term fluctuations that happen in a day, a week, even a single year are meaningless in that long term. These rapid fluctuations are no reason to make rash investment decisions. Plus, these short-term investment decisions can actually cost you more in taxes than long-term trades, as well as the fact that you'll likely underperform the long-term returns that you could have through dollar cost averaging, which just means buying small pieces of stock over a long period of time. In my opinion, beginner investors fail in the stock market because they lean too heavily either into the hurry up side of the statement or the and wait side of the statement. In my opinion, most beginner investors likely fail because they get caught up in these short-term hurry up decisions. For example, falling for FOMO, which is fear of missing out when they see a stock making a run up and to the right, or they panic sell when they see the stock market falling due to outside factors. This is going to inevitably lead to negative returns because most people, not even professionals, 90% of professionals are unable to predict the stock market. So any amateur investor like you and I is not going to be able to either. I personally fell for this in the beginning when I first started investing because I was caught up in the day trading, short-term trades of the stock market because that's how I assumed you made the most money. I thought that's how professional traders would do it, and that's how I thought I needed to do it. This caused me to lose a decent amount of money as well as lose a significant number of trades. I also fell for the FOMO of it all, getting excited when I see a stock on a run and I don't want to miss out on it and I'm afraid that I'm going to, so I jump on board only for it to tank from there because I jumped on right at the peak. Other times, investors will get caught up in the and wait part of this statement and they'll let their investments ride for decades without ever checking up on them, maintaining them, optimizing them, swapping investment decisions if they have to, ensuring automatic investments were happening as they should over those decades, many different reasons. If you're investing in individual stocks, this could mean riding a stock all the way down to zero, or if you invest in funds, then this could mean not balancing funds as you should over the long run. Diversification is really important for not only maximizing investment returns, but also protecting you from downside risk of investments. And if you let your investments sit for decades without ever checking up on them, it's very easy for your diversification to fall out of balance and suddenly be exposed to more risk than you initially expected. So what can we learn from this? Well, the most obvious thing is having a solid balance of hurry up and wait in your investment decisions and strategies. This also applies to other investments, from the stock market to real estate to crypto to many other investments out there. Having a short-term mindset when you just start investing is key to push yourself to start investing and realize how important time is. The longer we can give compounding to work over the decades, the better. And then once you start investing, focus on the and wait part of the paradox and give your investments time to grow and flourish, and don't react to short-term fluctuations and don't raise your taxes unnecessarily by making short-term trades. And with that, that's the end of this video. I really hope you enjoyed, and if you did, leaving a like below this video would be a huge help to me in growing this channel. I'm also very active over on Twitter, Instagram, TikTok, as always, links below in the description. But other than that, wish you the best of luck. See you next time.